Hey traders, Raghee here, and I want to do a quick audio and video check. Make sure that you guys can see my screen. You should see the radar right now. I think we're good. All right, so let's go ahead. I'm taking a look at the chat right now. We do have a group chat. I think I can see that. All right, so we don't use this Google Hangouts very often. You guys know that. But since we have our webinar at 8, I figured I'd go ahead and use this before we get started for our 8 o'clock webinar. So I will be recording this, so members, this will be in the members area. I'll just add it to today's chat archive. So you'll find that there probably later on tonight. And we're going to talk about the Aussie. So let's go ahead and get started here. It's a bit of a delay from what I can tell, a little bit more than I thought we would have, so I'll have to keep that in mind as well. But it's good to have you all here. And I can see we have about, okay, everyone's kind of making their way into the room. That's cool. All right, great. So we're going to start off with a look at the Aussie. We're going to do that till probably about 7:55. Take a quick 5-minute break, and then we will start with the 5 ways you are absolutely and brutally sabotaging your trading. So we'll start that at the top of the hour. Okay, super. I appreciate the feedback there. All right, so I can see. Oh yeah, okay, so you guys have to basically sign in to post a comment. All right, perfect. Thanks, Becky. Thanks, Bella. Thanks, Zenz. Appreciate that. If you do have any questions, let me know. And okay, awesome. That helps. Seeing the comments there, that absolutely helps. Perfect. Okay, super. I appreciate the feedback there. Yeah, we're a good 7 seconds, I'd say, 7 to 10 seconds delayed. All right, so let's go ahead and switch on over to the Euro US here. I do want to follow up on this just a bit. So let me get the recorder going. We will rock and roll. I want to start off our discussion with the Euro US because this has been such a major part of the developing story that we've had throughout the day. And there's just no working around it. If you have exposure to the dollar, or if you have obviously exposure to the euro, today's move in the fiber, the euro US dollar, rocked your world. There's just no way, there's no two ways about it. And the driver was indeed the euro. So as much as people might be talking about US dollar strength, what I want everyone here to realize is that dollar strength was that inverse correlation to the euro sell-off. So the driver, the cause for the euro movement lower and the dollar movement higher was definitely, ultimately, this euro sell-off. And it's pretty interesting that we're having this continued weakness in the euro US. I think that does communicate to us that after Draghi and that initial nearly 400 pip sell-off. In fact, if you think about it now, we talked about this in the chat room a few days ago. If you talk about what was baked into the cake after Draghi came out, said what he did on the last meeting on May 8th, and the market knocked on the door of 39.92, knocked on the door, actually the 140 handle, and sold off. Today's move, today's break through the 136 handle actually now represents a 400 pip sell-off. So when traders say that there hasn't been a reaction, or when you think about the sum total of the reaction from an exhaustion just shy of the 140 handle, now down to through, but not necessarily accelerating, but through the 136, that's 400 pips now. What is probably the most troubling is that the market did not stop at the 137 handle where we've had support, nor at the 36.50 major psych level where we've had support, nor at the 200 period simple moving average on the close, the 200 DMA, or the 200 SMAC as I'd like to call it. It did not stop there either. So it really wanted to make a beeline for 136. And once the market gets close to a handle, that 00 major psychological level, it's easy to see why the momentum would move down as we move in the direction of the most stops. That's the way price action Momo works. That's the way near-term price action, if you want to think about it as good old-fashioned tape reading, you know, if you're a time and sales kind of person from back in the go-go tech days of level 2 and time and sales, you know, if you're a tape reader, you know exactly what I'm talking about when I say the market moves in the direction of the most stops. It's not some sort of conspiracy theory type, you know, insidious thing. This is just the way the market works. It moves in the direction of the most stops, and it looks like 136 is it. Now, we're going into Thursday tomorrow. A lot of this breakdown is coming probably a little bit sooner than I would like, as the market is still discounting the unknown of the June 5th ECB event. So obviously there are traders still who feel they need to sell the euro, position themselves short in the euro-US in anticipation of whatever Draghi is going to say. And even at 137 and 36.50, I felt we had a fairly sufficient sell-off and the market had reacted to what Draghi may do. Quite frankly, the more we actually sell off without completely collapsing, okay, the more we sell off without completely collapsing. Now we're only about 40 pips away from the 200 period simple moving average. This is not a great distance, okay? Now, how do I measure that? You know, I'm not being subjective about it. In fact, let me go ahead and log into the power stats here because I think this is a perfect time to talk about what exactly 40 pips does mean. What does 40 pips mean within the context of what the euro-US dollar can do? Scroll on down here, head on over to the euro-US, and what I want to look at is not just the hourly price movement range. By the way, you'll see the high end of hourly price movement range is just shy of 36 at about 35. So is 40 pips a lot of movement past that 200 SMAC? Not at all. When we talk about a market that on a daily average can move about 50 to about 60 pips, and on the high average about 80, and to the extreme about 100. Now this doesn't mean the market can move 100 and no more than that. This is a historical likelihood of what this pair does specifically on certain days, going back with a look back of, I believe, 6 months. This accounts for roughly 2/3 of average price action. It doesn't account for the lowest low in terms of pips per hour or per day, nor the highest high in terms of pips per hour or pips per day, but rather gauging about 2/3 of the average. So 40 pips is not really a lot when you think about it. The reason we're starting out with the euro-US dollar here is because I want everyone to understand when we head on over to, and by the way, just to complete that thought, this weakness in front of Raghee actually, to me, with every pip we move lower, reduces the likelihood that Raghee will be able to sell off the euro on the 5th, unless he comes out with something much more dramatic than what is known and what is being discounted. And the more this market sells off, the more difficult that is actually going to be. So let's move on over to the Aussie US here. Let's move on over to the Aussie US. So what we have here is the movement we've seen with that US dollar strength. And one of the things I think a lot of Aussie bulls love is the fact that the Aussie was able to more or less keep up with. I mean, it didn't completely melt down. There was weakness here, but the Aussie was able to keep up with much of the US dollar strength. Now, when you take a look at we're going to talk about this concept of the individual currency story, and really with that comes dissecting the pair. One of the things to think about when you look at the Aussie versus the US is the individual strength story that is still the Aussie, and the individual currency story that is the US heading into an increasingly slippery slope. A lot of traders find this move bullish, and intraday it absolutely is. But when you step out and look at it, you look at the whole forest, not just the tree or trees, what you'll notice right away is the fact that what we have with this dollar index, let's see if I can enlarge this chart. That would be nice. Oh, where'd it go? Did I somehow magically lose my, I think I did. No big deal. Yeah, I sure did. All right, let me go ahead and exit this. Let me just restart it. Okay. All right, we are back in business here. Here we go. So looking at this dollar, when you blow this chart up, you'll notice the overall chop we have there. And even though we've gotten past 80.40, now 80.50, heading towards 80.60, don't forget that 200 period simple moving average on the close, the DMA, the smack as I call it, is waiting to maybe deliver a smack down at 80.67. But this market can go to 80.80. We've been up to 80.77 before, so obviously it's an increasingly slippery slope. But I just want everyone to realize that this is predominantly euro weakness driving this dollar up. And I've continually said one of the most dangerous shorts is a US dollar short, especially with there being no sign from the Fed that they're going to deviate from that October end to the taper. Now, what does that mean for the Aussie US? If you want to fade this move in the Aussie US, what you're actually going to do is buy Aussie sell greenback. Well, didn't I just say that the greenback short is one of my least favorite, one of the most dangerous shorts? It is. But the bet here, and I don't mean gambling, I mean the actual trade, the bet here is what? This is a distribution fade on an oversold stochastic. That's what this means. Distribution fade, oversold. The bet here is that even if the US dollar continues to rally, the Aussie can keep up. The Aussie can keep up in a foot race and maybe even outpace any greenback strength. This feeds right into the scenario that I am playing, the scenario that I am considering is a very real possibility, which is that Raghee June 5th letdown. If we've already sold off the euro 400 pips, who knows where we'll be by next Thursday, basically a week from now. Who knows where we'll be by then? Unless there is new indication that whatever Raghee has put out there since May the 8th and the discounting that has happened since May the 8th, unless there's something that dramatically accelerates the story, dramatically makes the current story even a larger one, a more emphatic case for QE, for what Raghee is planning to do. The bottom line is what we want to do is not study what he already said, but compare that with what's being discounted now. How do we do that, by the way? And why is this important to the Aussie? Well, the Aussie is sensitive to risk. The Aussie is one of the pairs we've been watching is the Aussie-US, so we can't ignore the euro impact on the US dollar and therefore our Aussie-US. There's no way to ignore that. One of the things we want to do is Google News Search. I mean, this is one of the most effective ways to understand what's being discussed, and I can do an easy keyword search of something like euro and Raghee. Okay? We can do, and these are from the 26th, we can see there. Euro touches 3-month low as Raghee signals action. What we want to know is, what do traders think is going to happen? Because if on the 5th, Raghee 1 doesn't deliver, or 2 doesn't surprise, the only way for the euro to go is up. This is buy the rumor, sell the news. But in this context, it's sell the rumor, buy the news. And I do believe this is turning into a sell the rumor, buy the news scenario here. So how does that factor into my Aussie-US? Well, if I'm fading the Aussie-US, if I'm looking at a fade here, if I'm looking at buying the Aussie, selling the greenback means if the euro rallies, the dollar index is going to sell off from that slippery slope within the range extremes. I'm not picking these levels out to fit a scenario. I am looking at areas of support and resistance that have already been established, and then I'm looking to see what story fits up in this area. What's working with the timing? What's the story up here? If my euro actually launches from here, it's going to send the greenback lower. By sending the greenback lower, that's going to allow the Aussie, give it a better chance to basically slingshot past greenback weakness and move higher within this range. So just as I'm a bear up in this area, I'm a bull on what is now a triple, if not quadruple bottom within the context of a distribution chop on this daily Aussie-US. This is always an aggro trade, by the way. Always. It's always aggressive because we lack an edge without a trend. Very few markets have trends for us. We've talked a lot about the euro pound. We've talked about the loss of trend in the cable. I mean, very few markets have a trend right now. So I don't have directional bias on my side in any shape or form the way we did earlier this year or late last year. So you guys know that we've been basically adjusting to the current environment, adjusting to the chop by ratcheting our previous trades, protecting our profits, putting in a trailing stop, and getting out of those trades where we were taking advantage of trends, whether that be the prior uptrend here on the Aussie-US or the prior uptrend on the Aussie-Loonie. I mean, this thing's gone. We took advantage of this trend for a while. This is a great trend. I can't keep hammering away thinking I'm going to swing by this thing when this happens, or definitely when this happens. If I'm going to persist with the same strategy that got us long over and over and over again, even here, if I'm going to persist that same strategy through this, what am I doing? I'm failing, I'm neglecting to listen to the message of the market. This market now has gone from 12 to 2 to 2 to 4, and that means if and when I can actually identify whatever the range may be, and I don't know what the range is right now. I think we're still hunting and pecking for it. But once I can identify what the range is, maybe then I can go about it aggressively entering distribution fades. But for right now, I do not have the same edge that I had back here. And you know, I gotta mention this because we probably have some folks here in the room that don't join us on a regular basis. The market movement here, and by the way, this golden cross is so lagging because we were looking at, you know, movement to the upside before that. But this is psychologically very relevant. This is a great thing to have on your side, even though it comes second to what we were doing before that, and the wave and the grab candles, etc. But one of the biggest mistakes that you're going to see are traders not understanding what was working through here fails to work through here. And suddenly a lot of traders start wondering, oh, does this strategy of mine actually work? Maybe it stopped working. Maybe I'm doing it wrong. No, no, no. You're doing it right here. If you're applying a trend-following strategy, buying into pullbacks, it's justified within the context of an uptrend. Predominantly green grab candles and a 12 to 2. But this here, that is no longer valid. And that idea of validity, that idea of saying the strategy that I used isn't bad. If I have a bag of nails, a screwdriver is going to do me no good. A bag of screws and a hammer is going to do me no good. All perfectly good tools on their own, but a mismatch, right? If I don't have the right tools. So one of the things I see traders do over and over and over again is be their own worst enemy by suddenly doubting their tools and indicators or whatever they're using, and not realizing that the underlying market has changed. So therefore, their tools have to change too. And that's what we're seeing over and over in the Aussie story. You know, the Aussie yen has a slightly different story in terms of the risk environment. You know, we talked about the yen and the Dow and the Nikkei this morning. We'll definitely talk about it again tomorrow in the chat. But one of the more interesting aspects of this Aussie yen is this push-pull with the Nikkei and the Dow. The Nikkei has taken out the first hurdle, downtrend line / 14.6. It failed at the next hurdle, the 200 smack. So we're not even talking about going to the third hurdle, which is waiting at 15,000. The challenge here is that while the Nikkei's got a little bit of momentum to the upside, it's actually an easier move to the upside on the Nikkei than it will be on the Dow. We've talked about this choppy, ugly distribution in the Dow. I think a lot of people call this an uptrend. I do not. I do not. And you know, it might sound funny for me to say this is not an uptrend. I might sound a little crazy saying that this is not an uptrend, but I'm going to say it right now. This is not an uptrend. It's not a quality uptrend if I want to even qualify it more effectively. It's not a quality uptrend. There is a bullish bias here, no doubt. But it's the lack of organization that keeps me from trusting this. It's the lack of organization that makes me think that even after an ATH, an all-time high, the market will be faded. So while a lot of pundits were throwing out numbers like 25% corrections, we talked about how ludicrous that number was when people throw around a number like, oh, there's going to be a 25% correction without the accompanying truth, which is 12.5? Really? You see the Dow at 12.5? I think that it's amazing to me how often the words 25% correction were thrown out there, right? Yet nobody really had the commitment to say, oh yeah, I see the market at 12.5. Really? That's a heck of a move. People are talking themselves back from that, which to me is troubling, as if to encourage the market to start buying again, when in reality, this is where the market could exhaust again. The very point where all these people were getting so pessimistic and talking about 25% corrections in here was the time that near-term buyers could start to bargain hunt. By the way, I would love to bargain hunt all the way down to 15.8. I would love to do that. In fact, not only would I bargain hunt equities names with good Dow weighting down to 15.8, I would look for opportunities to sell yen, especially against a stronger base currency. Aussie, Kiwi, pound. I know a lot of people are saying, wait a minute, Raghee, those three haven't been great base currency strength stories. No, they're not. But they still have probably the more and even you could throw the US dollar in there too. They probably have the most hawkish central banks. So if we get risk on, and I think the surest way to talk about risk on is after possibly a sell-off from ceilings, from exhaustion levels in the Dow to different levels of support in the Dow or in the Nikkei even. And for those of you wondering, why has this Dow not been rallying the Japanese yen? I'm going to jump on over here to the Japanese yen futures for a moment. Why is this thing flat? We're looking at all-time highs on the Dow. How come we haven't taken out 2014 lows? Because the yen continues to have to serve two masters. It's having to continue to deal with the risk off in the Nikkei, and then conversely the risk on in the Dow. And because the Asian session's one psychology, the US session's another, this yen can't get out of its own way. So Nikkei heaviness, yet all this strength in the Dow. Hey, we've been flirting with intraday all-time highs for a couple sessions, right? How come we can't see any really some pronounced yen selling, evidence of risk on the table, risk appetite? Because the yen continues to have to serve two masters, the Nikkei and the Dow. So it's actually on pullbacks that I'm able to become more a yen seller against currencies that I believe do have support or the ability to accelerate, like an Aussie, like a Kiwi, like a pound, if the data can help us out here, even the dollar. In fact, the last entry in the yen that we had in the trading room was the fade, and I know a lot of you got this and enjoyed a really nice pop on the dollar yen. Distribution fade buy. So this is something to think about as we move through, not just this week, but move through summer. So partly the reason I wanted to talk about the Aussie is because when you go into the economic calendar, we have the private expenditure release at 9:30, and that means that we're going to be looking for catch-the-wick opportunities, but I don't know that we have that many that have proximity. But the same idea with a catch-the-wick on the Aussie, we're going to have plenty of opportunities to do this going into the Chinese data and going into all the Aussie hot zones next week. All right, so that is our kind of warm-up to our webinar. I can see some folks are making their way in now, so we're going to start that 5 ways you are absolutely brutally sabotaging your trades. We're going to start that up here in about, I'll give you about 5 minutes. They take 5 minutes here, and we'll start that up here shortly. And I'm going to save this video. Members, I'll have this archived in the members area. And we'll get going on the sabotaging. We'll do that here shortly, okay? Sabotaging. Coming up next. Okay. Okay, so I'm going to mute the mic for a bit, and we will start this presentation here in a few minutes. Okay, we're back. So for those of you that joined me for our 7:30 breakout session on the Aussie, a lot of discussion on the euro and the dollar as well, no doubt. Members, I'll have that posted in the members area tonight. I'll get that posted tonight. If you have any questions, you know where to reach me. And let's go ahead and start our sabotaging or sabotaging sabotage. Let's get started with this webinar. It will be recorded. Yes, this is live. I don't do pre-recorded stuff. I am sitting in my home office here in South Florida. I have a bottle of some nice lemon seltzer water. I got some lemon water. I did not do the coffee or the Red Bull today. So this will be a decaffeinated discussion, which is good. Cooler heads must prevail. So thank you for joining me. And this is the first time we're actually doing one of these on the YouTube/Google Hangouts. How do you guys like it? First time we're doing this. We did it in a pinch one time, but this is the first time we're doing a Google Hangout/YouTube production. What do you guys think? Now, the chat room we use in the morning is dedicated software for our purposes, and frankly, I do like it better. But I thought this was pretty easy. All you guys have got to do is just go to YouTube. So, I think that's pretty easy. Keeps it simple. So, yeah, if you guys have any feedback on this, let me know, because I wouldn't mind doing this from time to time. Yeah, no BLK water. No, Bella. I'm not rocking the BLK. I do have some Penta water, and no cold pressed coffee either. I've got to get back to that place and get some cold pressed coffee because that stuff is awesome. Yeah. So welcome, members and non-members alike. I'm Raghee Horner, and thanks for joining me. Let's go and get the recording going, and we'll talk about what we're here to talk about. So if you're joining me here, you're doing it because one of two reasons. One, you're probably doing okay in your trading, and you know there's something better waiting out there for you. There's a better way you can apply the tools and the strategies that you know. Or maybe you're one of the many, many traders who is having issues just getting out of their own way. And you're doubting the indicators you're using. You're doubting the strategies you have. You're thinking that you have to start from scratch, whatever it may be, but you're in a place that we've all been in. But in terms of having the confidence to build your career and to keep moving forward, the thing that you have to remember is it's not always your strategy. Sometimes it's the application of. So we're going to get into the 5 ways you are sabotaging your trading. Now, I actually have a total of 14 ways. I mean, there's actually 14 things that I have observed over the course of about 25 years in my trading and literally in the trading of thousands, not hundreds, thousands of traders. I've taught all over the world. I've taught in rooms from 10 or 12 people or less to over 1,000 people in French, in Korean, in Spanish, you name it. It's amazing how often the mistakes that we make are similar regardless of the market, futures, options, forex, equities. regardless of where we live. These are very common mistakes, but they're not all mental errors. I'm not going to talk about touchy-feely, follow your trading plan, and don't use too much leverage. Every time I read one of those, I think, really? This is after all these years that I've been reading these articles about psychology, it's the same stuff over and over again. How many here, raise your hand, I can't see it, but how many here have seen that, read 100 articles on the same kind of touchy-feely psychological stuff, your inner child of trading? Not that that doesn't have a place, okay? Not that that doesn't have a place, but the bottom line is a lot of the mistakes that we're making are completely different from what we've been told the real problems are, okay? And these are the first 5 of actually 14 different things that I've found traders do consistently, regardless of the market they're trading. And here I'm going to talk about some very Forex specific issues, because I realize most of you here are Forex traders. So we're going to get into these right now. Hopefully these are, to people who are already members of TFF, this should echo very familiar, because we talk about this stuff day in and day out when we're setting up our trades. But for those of you that are not familiar with what we do, this is really at the heart of how we set up and manage our trades. So you're kind of getting a peek behind the curtain of what we do day in and day out at the site in our live trading room. So let's talk about the first here. And this isn't in any specific order. I just think this is in an order that makes sense as we make our way through this top 5. And that's not dissecting the pair. Now, if I were talking about, this is very easily, obviously, a Forex conversation. But this can be applied to an equities trader looking at an equities name and ignoring the sector and or the larger index that it might have a significant weighting in. Okay, so there are applications beyond just Forex, but it's most easily and most effectively applied to Forex. And what is dissecting? I know this is a topic that it could be very new to some traders. I find that most traders who are in the Forex market do not actually think about the individual currencies of the pair. In other words, splitting a pair into its 2 individual currencies. They always talk about the Euro-US, or they always talk about the Euro-Yen without saying it's the Euro versus the US, it's the Euro versus the Yen, and each one of those individual currency stories could have completely separate events that are affecting them. So it's vital that you split the pair into its 2 individual currency stories and understand the themes, central bank stances, economic releases that are affecting both. Let me give you an example here today, and I think this is a really good example. In terms of what is dissecting, it's splitting the pair into 2 individual currency stories. I think nowhere was that, to me, more interesting today than in the pound US. Now, we could probably find an example of this every single day, but this is the fun part about doing these things live, and that is looking at examples that have just happened. This breakdown in the cable, is it all just pound sterling weakness? No. The pound sterling has had 2 days of weak data, and I don't mean high impact or what I call high heat data, but rather medium impact, medium heat data. 2 misses, 2 pretty big misses in pound sterling data, but not off numbers that would typically tip the market like this, to the tune of this kind of candle. Why the breakdown like this? Why such the violent breakdown? Couple things. We have a 6-month uptrend line that has been broken. That in and of itself, on the other side, on the south side of this uptrend line, you're going to have sell stops waiting. That's going to create some of the acceleration. We've bounced off it before. We broke through it convincingly today. Pound sterling weakness, definitely part of the equation. But when I say this pair was firing on both cylinders, what I'm talking about is the pound did its job to drive itself lower, to drive this pair lower, and the US dollar did its job to drive this pair lower. So what does that mean? That means I had pound sterling strength while having pound sterling weakness while having US dollar strength. Now, the US dollar wasn't necessarily the driver of its own destiny. A lot of that was actually the euro. So when we take a look at a breakdown in the cable, what we're actually looking at is British pound sterling weakness and euro weakness. That euro weakness in turn created the dollar strength and gave this market that big red down candle. So when I talk about dissecting the pair, understanding why something's happening, if the dollar were flat or if the dollar were weak as well, we would not have seen as big a move. But because we have each individual currency doing its thing, the push-pull as I like to call it, the pair firing on both cylinders, we had the movement lower. That's how this works. Understanding each side. And when you step back and say to yourself, whoa, euro weakness, dollar strength, British pound weakness, I'm seeing a trend line break, I'm seeing a break of a 6-month trend line. I'm seeing a break of the 6750 major psychological level. Recent lows are being broken. You get out of its way, especially when you realize the truth of the matter, which is once you dissect the pair, it's not like one side of the currency is doing all the heavy lifting. They're both at work here. And the way you know that is you dissect the pair. By the way, part of this question is understanding then if there is one side of the pair doing the heavy lifting. And there always isn't. Just, a lot of people assume it's both currencies moving. That's not always the case. That's not always the case at all. Let's take a look at a related view. Here's a euro pound. The euro pound actually moved higher today. Take a look at that. The euro was weak. One look at the euro US and you can see the euro weakness. So no question about that, right? There's that big red candle. The euro was weak, 100%. That was the catalyst for a lot of the greenback strength that we saw today. But we're seeing actually movement to the upside on the euro pound. Why is that? This is a scenario where we had a weak euro and a weak pound. The movement higher tells me what? The pound was weaker still because the euro was able to gain against it. So this is a very weak pound sterling. Now, I would love to take advantage of that moving forward. In fact, we're looking at some setups where we can take advantage of the correction and probably one of the few trends we actually have on daily time frames. In other words, this is one of the few pairs that actually has what we call directional bias. So this is one of the pairs that we'd love to take advantage of, preferably going into the latter part of next week when we get our MPC statement, going into the ECB, and then ultimately going into the non-farm payroll. So again, dissect your pairs. Understand what each currency is trying to tell you. And if you do that, you can avoid this second issue, which is a lot of traders I observed, especially again, these are some of the more Forex specific of the 14 that I've observed over basically 2.5 decades. A lot of Forex traders unknowingly, because they're not dissecting their pair, hedge themselves. In other words, they end up in positions where one of their pairs will do very well and profit while the other one will give back profit or be a losing position because they don't understand the tug, the push and pull of the currencies, the individual currencies. So a very common mistake some rookie traders will make oftentimes would be something like not understanding the way in which the euro and the US have that inverse correlation. Let's talk about that for a moment. I'm going to pull up on this left side the dollar index. Dollar index, of course, is a futures contract. And I'm going to pull up the euro US on the right. These are 2 daily time frames. Both these are pretty darn ugly right now, but I don't think it takes much to realize that these two move pretty much and pretty tightly inverse to one another. Here's a 5-minute look at each one. I mean, if that doesn't really drive the point home, right? So we have an inverse correlation between the dollar and the euro-US dollar. That means the euro-US dollar is always firing on both cylinders for the most part. I hate saying always, but more often than not, much more often than not, the euro-US is firing on both cylinders. Euro weakness means dollar strength. Dollar weakness means euro strength. So if I am looking at the euro-US, or let's say no, let's use an example like if I'm looking at the dollar-yen and I'm looking at the euro-yen. I do have the yen in common. We're dissecting the pair now, right? So I do have the yen in common. Let's say I want to sell yen. Step one would be what? I won't even say step one, but part of the process would be dissecting the pair. If I'm basing the trade on, say, yen weakness, because I believe there's going to be risk on, equity strength in the Dow, equity strength in the Nikkei, and that means a weak yen. So I want to sell yen. And then I come to, let's for example, these two choices. One of the decisions I've got to make is which base currency, the euro or the dollar, is the stronger of the two, just comparatively. Yen weakness is going to be the commonality, but which currency, which base currency would be better to buy against the yen? Or better yet, which base currency would be better to sell the yen against? So when I step back and do that, I've got to do what? I've got to understand the themes around the euro. I've got to understand the themes around the dollar. I think generally speaking, longer term, I think a lot of traders would say, I'd like to buy US dollar, sell euro. Right? So for a lot of traders, the US dollar versus the Japanese yen might be a little bit more tempting an entry. Now, near term, I think going into next week, we could see an interesting little pop in the euro. So, near term, there could be an interesting opportunity to buy euro. I'm not ruling that out. But if I had to play something going into year end, I'd probably be more tempted to find a foothold at a support level that I could buy dollars, sell yen. But again, the only way you can even start that discussion is if you understand dissecting and then understand harmony. Would it make sense? Let's talk about harmony for a minute. Would it make sense for me to sell yen against the dollar and the euro? Likely no. Why? Because if the dollar is stronger, the euro is weaker. So whatever I'm doing against the yen, I'm going to constantly hedge myself because I'm long dollars and I'm long euros. I don't want to hedge myself. And not understanding harmony would cause me to enter that kind of position. Harmony also lets you know when you're entering a lot of the same kind of position. So we have something like dollar versus yen, right? Well, if I'm going to buy dollars, anytime I'm going to also buy euro, I want to be doubly cautious. Now, I could look at something like buying the euro against, something like the loonie. And if loonie weakness is the driver here, I can buy euro yen and I can buy euro loonie, getting long the euro. That's no problem, right? But what about doing something like euro yen and dollar loonie? I need you to understand the connective thread between the euro, the dollar, and even the franc. Remember, the franc is pegged to the euro, so that's got to be inevitably a part of this conversation. I need you to understand the relationship between the Nikkei, the Dow, and the yen. even the sympathetic relationship between the Aussie and the Kiwi. So when you start entering trades across multiple pairs, you've dissected, you know the driver, and you are not unknowingly hedging yourself. You want to build a book based around themes or a single theme. I mean, there have been times when the loonie was short, right after Mark Carney departed for the BOE and Stephen Pelosi took over the BOC. There was a time where I was pretty much selling the loonie against everything. My book was built on a single theme. Now, some people might say, well, that's awfully unsafe. I did it against a number of currencies. If I felt that I could pit the loonie against a stronger base currency, I did it. But there was harmony there. I even had positions where I was long US dollars and long the euro against the loonie because the loonie was so darn weak. As long as the euro and the US pretty much moved sideways or in a range, the loonie would continue to weaken against them both. So you can see where the lack of harmony and understanding the theme or the currency or a particular event can have you missing out on this one, being able to build a book around a single theme and really benefit from an individual currency story that's working, like last year's loonie sell, last year's pound sterling buy. Okay. I think another mistake that traders make, again, related to this, and if you guys have questions, I can see your questions. I know many of you are joining me here at YouTube. Some of you might be in the Google Hangouts with me. Type in your questions. I can see them. Feel free to do that. Another part of this, and by the way, I hope you're already seeing how different these points are in terms of the way you're sabotaging your trading. I hope you're seeing how different they are from the typical discussion. Okay, and if you have any questions, let me know, because these are, for a lot of you, might be ones you've never heard of, never thought of, and maybe for some traders, somewhat advanced. For others of you, this may be stuff you've heard of before. I would hope so. I would like to think some of you have thought about these things before. Okay. By the way, this little outlining platform I'm using, I'm not a big fan of PowerPoint. This little outlining program that I'm using is called Workflowy. It's a terrific tool. I don't know how many of you have ever tried it out, but I'll be sending these notes to you along with the replay to your email addresses later on. So I got a question or a comment here. Harmony doesn't necessarily work with the yen. Well, it depends on what you're talking about in terms of harmony. You know, if you're talking about yen harmony, if the yen is the driver, if the yen weakness, let's say we have yen weakness because we have Dow strength and Nikkei strength. If the yen is the driver, yen weakness, there will be perhaps an opportunity for me to buy euro yen and buy dollar yen. If yen strength is the driver, there might be an opportunity to short euro yen and short dollar yen. Short positions in both. But it really depends on really what point number 3 is, understanding the individual currency story. Because if my euro is the driver, and right now I don't think the yen really is a terrific driver because we're in places where the day-to-day risk environment doesn't have organization. So I don't really want to base my follow-through, my expectation of follow-through on clarity in the yen. I don't want to do that right now. This is not a great environment for it. Okay? But what I do want to remember is if I'm playing these two pairs, the euro and the dollar are where I have to determine how I want to position myself against the yen. Longer term, I like dollar strength. Going into next week, I'm actually very nervous about the dollar. I think it's at a level where it could be shorted, meaning where we are in the dollar index. Going into next week, I smell short squeeze in the euro. So near term, I'd actually like to sell dollars, buy yen, buy euro, and sell yen. So let me say that again. I'd like to actually fade short sell possibly the dollar yen, possibly. I mean, I'm more interested in short selling the dollar index up at this level. It may not be best expressed by the dollar yen, but I am interested possibly in buying euro, selling yen. In fact, if I'm going to play a euro strength story, I'd like to find a second currency that has the ability to be weak as possible. In fact, if I'm going to buy anything, I'd like to buy it against a much weaker individual currency story. So that takes us to number 3. No clear individual currency story. What are the themes surrounding every currency that you're trading? And it could be even short term, like the economic themes on the calendar, today's calendar. The Aussie is on. The Aussie has an individual currency story tonight, just because of its hot zone, because of the economic release coming up tonight. What's the story around the Aussie? Well, we have the RBA coming up next week. Okay, so what's the story around the Aussie? Do I still believe the RBA is going to have to be hawkish at some point? Are we at levels of support where I could buy Aussie? What would I like to buy Aussie against? You know, what's that weaker second currency? Or what's that weaker other currency that I'd like to buy Aussie against? You know, going into next week, I don't know the euro is going to be one of them. I think a lot of people might be tempted to want to grab a piece of euro Aussie thinking, okay, if the Aussie's going to strengthen, let's do it against a currency that's getting hammered right now. But I think this is actually a very dangerous short sell, regardless of whatever I think about the Aussie, because I think the euro could pop, and that means move up higher, and we're actually near levels of support in this euro Aussie. The only way I could do that, the only way I could split the stories up, is I don't look at the euro Aussie as a single story, but rather as breaking it into pieces. Dissecting it, looking at the harmony across my entire book, and then getting into the individual stories. And these are, like I said, these are a little bit more complex, a little bit more advanced concepts. But again, when you find out, when you understand what's sabotaging your trades, and you're able to start understanding the themes behind the individual currencies, it becomes much easier. And we do this every morning in the chat room. I mean, for those of you that are already members, you know a big part of what we do are find those individual stories and then ask ourselves, you know, for example, the loonie has been emerging as potentially a more bullish story as of late. But here's the problem. What do I want to buy loonie against? Or better yet, what do I want to sell against the loonie? So you can have an individual currency story, but you may not have a pair that's really feeding you a trade. And that's oftentimes something that a lot of traders don't understand. They can have an individual currency story, but sometimes there isn't a great place to express that story, which is why you sometimes just have to wait. Take your hands off the mouse and just do something else. Take your hand off the keyboard, you know, and do something else. Okay? So, moving to our next point is a lack of directional bias. Now, the first 3 themes are absolutely vital and necessary, but probably a little advanced. But I want to just kind of begin the discussion here, kind of elevate the level of debate here. Just have you thinking about these things a little bit more meaningfully before you just get into a pair. Think about, okay, wait a minute. Raghee did talk about what's the story with the euro, what's the story with the pound, what's the story with the Aussie, before I just go play this pair. What are the economic releases that could affect either half of the pair? Okay, but this number 4 is pretty darn easy. Directional bias. When you are formulating your watch list week in and week out, and I look at a watch list about every week to about 10 days. What I'm doing is I'm scanning. I just start alphabetically. I start scanning the daily time frames, looking for those charts that have what I call a 12 to 2 or 4 to 6 o'clock angle. a 12 to 2 or 4 to 6 o'clock angle. That's it. That's it. I go through each pair just alphabetically looking for either the consistency of red or green grab candles and the potential for a 12 to 2 or 4 to 6 to give me insight into a larger psychology uptrend or downtrend. That is my primary watch list. And the edge that I get from focusing on markets that are in a trend is this. Trending markets are way more predictable. Way more predictable. For those of you that are wondering, and I don't know, some of you might be great faders. You might be a little bit more, if you're more of a trader who likes to fade or considers yourself contrarian, however you may define that, you might find the last few weeks or last month or so has been great. I would guess, though, I would hypothesize that most of you had a much easier time trading through fall, winter, and even the early part of this year. And the reason for that is the predictability of the markets because of the trends that we actually saw more often than not across a number of pairs. We had more trends last fall, last winter, and the early part of this year. Not everything, but way more trends. In the middle of last year, anybody who was buying pound, think about summer into fall, anybody who was buying pound and selling loonie, or even better, buying pound versus loonie, you were having a grand old time. There were certain themes that were just fantastic. I can't force a 1,500 pip trade. I can't just impose my will to say I'm going to buy a 160 handle and ride it up to the 185 for 2,500 pips. I can only get that when the market does that. And the individual currencies, buying pound, selling loonie against darn near anything, worked. And the follow-through was tremendous, time after time after time. So, you can only take what the market gives you. And the market's just going to give you more when you have a trend. The trend is your friend until it fades or ends. That's it. So your primary watch list, this is really what I really want to make sure everyone understands. My primary watch list, when I am the busiest and the happiest, and frankly, the most profitable, is when I have directional bias, when I have those 12 to 2 or 4 to 6 o'clock trends. That is, without a doubt, where everything just works best. Okay, and if you can focus on those trending markets, even if you're a day trader, short-term trader, you're still better off trading markets that are trending on their daily time frame. Part of that is also recognizing when we start to lose directional bias, your trading activity really should start to change. Your trading activity really should downshift. In other words, to slow down. I don't mean downshift as in, downshifting your hot rod and hitting the gas. I mean slowing things down. I'm at an idle right now, and I'm happy with that because I had a great fall, great winter, great part of early 2014, and now I'm dealing with the lack of directional bias, the chop, the confusion, and I reduced position size, reduced activity, and I'm protecting myself by being much more choosy about what I get into and much more nimble when I do get into it. The market environment has absolutely changed. And that observation is Charles Dow Theory 101. That observation is what keeps you using the most effective type of strategy, because you're applying a strategy not because you just feel like it, but because that's what the market would best react to. Or your strategy is best designed to pull pips out of markets that are either trending or non-trending. So, if I could give you homework going into tonight or this afternoon or morning, whatever time it is where you're at, if you could take your current strategies and put them into two categories. Are they trending strategies, following or reversal? Are they trending strategies or are they non-trending strategies? And from there, you could even break it down into other types. But if you could just do that and then apply tools like the wave and grab to determine when you would want to use your trending strategies, okay, trending strategies versus non-trending strategies, if that's all you did, if that's all you got from this talk tonight, I can tell you with absolute certainty it would create a sea change within your trading. It would absolutely revolutionize your trading. That alone. That alone. That simple task alone. And then following up with that task by applying your strategies in what I would consider to be the correct, the right, the most appropriate market environment. So the last one here is point of validity versus pips. And again, this one is one of those that a lot of traders are probably the most, I don't want to say skeptical, because I think when they hear me out, they realize, okay, this does make sense. It's just not something I've heard before. Most of you out there are probably doing something very similar to what I first did when I started trading, and that is using a 1% or a 1.5% or a 2% stop. Why are we doing that? Other than the fact that we have to put a stop in the market or know where our trade is no longer one that we want to keep open, how about thinking about when a trade is no longer valid? How about asking yourself, when is my trade no longer valid? This has nothing to do with a stop loss necessarily. This has nothing to do with dollars or pips or percentages. If I know I got into the market for a series of reasons, when should I get out? It shouldn't be dollar-based. It should not be dollar-based, although that is a consideration. The percentage of 1 or 2% is completely random. It actually comes from hypothetical portfolio management marketing material. If you want to get right down to it, a lot of that came from traders who are money managers promising their clients that at worst comes to worst, the worst they could do on a single trade is lose 1% or 2% of your money. And that became a stop. That's just wrong. Your point of validity isn't somehow pegged to 1 or 2%. It should be based on support or resistance. It should be based on where the market's been before, and price action momentum, and historical, reliable, repeating price movement ranges. It should be respectful of the volatility of that pair. The euro pound doesn't move anything like the pound yen. Okay? Doesn't move anything like it. You know, how do I know that? Because I have access to tools, and so do you, by the way. This is AutoChartist Power Stats. You can get this from a number of brokers. I call this my not-so-secret weapon because I was privileged to know these guys way back when, before this tool came out. And I remember when they first showed it to me, it blew me away. I said, do you guys realize what you've done here? This is way beyond an ATR. This is way beyond that. This is unlike anything else when it comes to showing traders how they should manage their trades, manage their expectations, manage volatility, not just day to day, but hour to hour. We rely, for the most part, on price and price action to get us into a market, yet we suddenly abandon that when it comes to getting out. And I never could understand the logic in that. In fact, I think it also explains why so many of us struggle with respecting our stops. If you're basing your stop on something as subjective as 40 pips or 1%, what's to make you say 45 pips isn't okay, or 1.5%? If your risk is $100, what's 110? Oh, what's 150? Because there wasn't a reason. You imposed something without logic, and your brain knows that. There's a good reason why a lot of traders don't obey their stops. because they're based on nothing, and your brain knows that. It's based on some random personal threshold, and not that dollars shouldn't be part of the equation at some point. 1%, 2%, $500, whatever it is, that could be an uncle point, meaning if a trade exceeds 2%, if a trade loss exceeds 2% or 60 pips or $500, it's unaffordable. It's unaffordable. Doesn't mean it's not a good trade. I just can't afford it. When you use the charts to get in, you use the charts to get out, and those levels don't care about my account and my risk tolerance. They just are looking at where the market's been. And if those levels represent a loss that is too great, reduce your position size, look for alternate support or resistance levels, or just don't take the trade. Simple as that. And I'm simplifying a fairly significant process, this idea of point of validity, yet it's so unbelievably simple, yet there is some subjectivity to it, because now you have to know your entry strategy inside out and well enough to know when it's working and when the wheels are falling off the wagon. And when the wheels are falling off the wagon should have a price area or a price level. Key levels, as you mentioned, my friend. You're right. There's got to be some sort of level that represents where that trade is no longer valid. So if you say to yourself, that's a stop loss. I don't call my stop losses stop losses. To me, they're points of validity. It may be semantics, but for me, saying to myself, this trade is no longer valid sends a completely different message to my mind, to my central nervous system. It has meaning, not because it's something that I just said I don't want to risk more than X dollars or pips or percentages. I've already seen what kind of pip movement I need to expect. I need to allow the market to move. Objectifying it, making it more concrete and less about my opinion or my comfort level. So when I start to look at a market and break it down, my entry, if I understand my entry well enough, I understand my unentry well enough. And the power stats is a big, big part of that. Okay? So I don't know if any of you have any questions on what we've covered so far. I have recorded this, and I hope that you can review it. If you do have some questions, feel free to let me know. You could actually email me if you'd like at ragheehornerblog@gmail.com. Feel free to email me if you have any questions. So I did want to mention that we are bringing back the $7 trials to TradeForexFutures.com. So if you've never tried our service, I will be sending you a link to the email that you that you registered with. I'll be sending the $7 trials to your email inbox. So if you want to learn about not just what we've talked about here, this first 5, but want to get into the next 14, the next 9 for a total of 14, we'll be doing that. There we go. We'll be doing that premium for members only next week. Okay, these are the first 5, and I'll be getting into even more. I'll be covering these 5 again with a little bit more detail, and getting into the remainder of these 14 ways. So I hope this kind of opened your eyes to some of the more tactical ways that are tactical things that you might be omitting from your current trading plan. And I hope it opens your eyes to maybe a different way of managing your trades, even seeking them out and understanding risk. So I hope, again, it's just I'm hoping that we're going to just keep this discussion going. Now, there's a couple things we offer over at TFF, and we have a daily morning chat room which goes from 8 a.m. to about 10:15 a.m. Monday through Friday, and if you can't attend live, by 11 a.m., about 30 to 45 minutes after we wrap up, by 11 a.m., the chat is archived and available at the site. It's archived in the members area. So even if you can't attend live, you can check out the chat. I break it down into individual pieces, and you can watch the section for you, the one that applies to you best. You know, if you want to break down the euro, we had a discussion about the euro. The pound, we had a discussion about the pound. I talk about my watch list, and I also send out a morning recap email. Some of you might have got that today, so you can see some of the individual pairs and themes that we're talking about. So we've got that in there. We have premium videos talking about my setups. I actually share my actual trading terminal with you, my trading terminal, as well as my setup chart, so you get to see my exact setup charts. I don't just give you buy here, sell here. You get to actually see the chart with all the levels that I am looking to build a position at aggressively, conservatively, cheated in stop losses, point of validity stop losses, and at least 1 to 2, if not more, profit targets. So you not only know what it is that I'm in because you're actually looking at my live terminal, you get shots of that, but you also see how I'm going to manage it, and you see it on the chart rather than just a bunch of random prices. I don't like just random prices. I want you guys to see the setup chart that I've built out, why I put levels, because I want you to have that visual evidence. So when the pig in the head takes over and wants you to change the trading plan, you've got a visible reason as to, wait a minute, this is why she put that stop loss in there. There was previous support or resistance. This is why she's putting that profit target in there. I want to step out in front of an all-time high, or I want to step out in front of that handle. Okay, so you'll get to see and understand why we're doing what we're doing. Really important there. So check it out at Raghee Horner, and did I misspell it? Okay, you guys know my name. Raghee Horner blog at gmail.com. Raghee Horner blog at gmail.com. Okay, so we got the trading terminals, the premium videos, the chart setups, and then starting next month, we're actually going to have premium educational breakout sessions, which will be anywhere from 2 to 4 hour, really deep dive webinars into specific topics. Whether that be something like this month, where we're going to talk about what's sabotaging your trading. Next month, I have actually scheduled futures, currency futures, and options on futures. That's what's going to be scheduled for next month. So every month we'll have a particular topic: risk management, price movement. I believe we have a Fibonacci and chart pattern discussion. So I mean, we're going to have a particular topic each and every month, and have a 2 to 4 hour deep dive. And there'll be an archive of all these presentations available to those of you that are interested in that more educational aspect to your trading. You know, and basically what we found after a lot of discussion with current members and people who are interested is that most people are either looking for active trading ideas, which is what we do every morning, and then with the emails that I send out and the charts of the day, or they're looking for a combination of education and trading ideas. So you can go check that out here at tradeforexfutures.com. And like I said, I'll send out an email. I don't want to bug you guys with too many links right now. I'll send out an email with all this information later on, as well as the replay for this presentation. In fact, I might actually give you guys a couple other bonus replays to check out, because I really want you to think about these points and how they can improve your trading. At the end of the day, whether or not you become a member or not, what I hope you take away is just some different aspects that are just simply not covered in most discussions about what's going wrong with your trading. Most of the time, I will tell you this right now, it's not the strategy. It's when you're using the strategy. Okay, indicators, stochastics, CCIs, all of those are great. It's really humorous to me how many people battle over which is the best indicator instead of really having the most frank discussion, the most helpful discussion, which is when are those indicators best used? A stochastic and chop is awesome. Within the context of a trend, it's useless. Okay? So it's not that the indicator is bad, it's when are you using it. If you have a trend following strategy and you're trying to use it in chop, you're going to be very frustrated. If you have a breakdown strategy taking advantage of momentum on the other side of support or resistance and you're applying that to a choppy market, you're going to get whipsawed at each end of the range. That contrarian trader who's thinking that every ceiling is an opportunity to short and every floor is an opportunity to buy is going to do great in a wide choppy range and get hammered in a coiled accumulation market. So every one of those strategies is effective. It's when do you apply them? And that's really kind of my calling card. That's my specialty. That's what I have found has made the difference for me. Not a new strategy, not a new book, not a new indicator, but taking what I already know and obviously have glommed onto because I like and applying it in a much more effective way. That's Charles Dow 101. Okay, so let me tackle a few questions here that I can see in the text area, and we'll kind of wind down our talk. And if you do have any questions, you can, again, you can email me. Thanks for typing that in. For those of you that caught my typo there, RagheeHornerblog at gmail.com. Feel free to, if you have a question, feel free. I wouldn't offer the email if I didn't sincerely want to hear from you. So let's see. Do I have a different point of validity based upon the time frame I trade? The point of validity is primarily based upon the strategy that I'm using, and the time frame to a certain degree based upon the price movement range and near-term support and resistance levels. So let me put it to you this way. The approach, the mindset behind it isn't different, but the level might be different based upon the time frame and the pair in terms of price movement. So we do have to recognize the price movement range for sure. If you look at the price movement, look at this, 55 pips in the high end, nearly 55 pips in the high end, an average of about, what, 35 to 45 per hour during really the prime time hours for the pound yen, right? But let's say I go over to the euro pound. Look at the difference. 16 to the high end of about 24. In fact, I can tell you the daily pip movement range is comparable to the hourly pip movement range of the pound yen. Do you think I'm going to have different expectations for follow-through, different placement for stops in this pair than I would the other? Absolutely. Okay, that's what I mean about respecting price movement ranges and building a plan specific not just to the market trend and or the time frame, but even the pair. And I'm not doing this completely in a discretionary manner. I am using tools that allow me to make it much more objective. Okay? All right, so thank you for that question. So why am I buying Euro US when the wave is 2 to 4? I'm not buying it yet. I have actually options. I was looking to buy it. I have options. That's what we've talked about. Picked up some calls at the 200 smack. So I am long via options. That's one of the things we do in the room. There are times where I'd rather just get long the underlying futures contract via options when I have a high risk environment. So I have options, and that's what we did here. Picked up some calls. So I am long because I believe we're going to see a pop in the euro on a June Draghi letdown. That's the theme that I'm looking at. I just see it with a 400 pip sell-off What is Raghee going to tell us next Thursday that's going to shock us more than the discounting already is representing? And if I'm wrong, I've got an option. My risk is absolutely limited to what I paid for the option. So that's what I'm doing there. And thanks for that question. Let me scroll down here, some other questions. As far as my examples of, making sure you're not inadvertently hedging yourself and understanding the driver, I know that can be kind of complicated. If you join us in the room on a fairly regular basis, all this really starts to gel. And by the way, if you're, I know a lot of folks say, look, I don't have the ability to go ahead and sign up right now. That's where you do the $7 trials, gang. You can spend a minimal amount just to make sure I'm the right mentor for you, that my trading style works for you, and kick the tires for a month, for a whole month. Okay, you can see what kind of profits we're pulling out of the market, the trades that we're taking, and make sure it's a good fit. Okay, so that's what we offer the trials, and that's what I will send to your inbox later on. So if you do want to try it out, you can. I don't, but if you do want to sign up, we have all sorts of DVD bonuses for those of you that are just ready to jump on in, which is awesome, obviously, as well, too. All right, so let's see, what other questions do we have here? Let me just read through the list. Do I have my FX book? I'm not sure that I know what my FX book is. My friend, my FX, there's so many different services out there. I'm not sure what that is. My FX book, what is that? Some sort of service? I'll check it out. I don't know if anybody here is using that. But I'm not familiar with it. So sorry about that. All right, any other questions? The video resolution wasn't great? All right, well, the recording will be fine. So you guys can check that out. I'll send everyone the recording. It is being recorded, so if the resolution wasn't good or you had technical issues, my apologies, but we should have a really good recording. Not only of that earlier Euro, US dollar, and Aussie discussion, but also of this presentation. Does anyone have any questions? You guys have any? I'm looking at the questions that are posted on the YouTube page. I'm not sure that I can actually see them on the Hangouts page. This is still something I'm kind of experimenting with, but I do kind of like it. It does make it very easy to attend, and that I do like. I like it easy for you guys. Okay, so I will send out the replay. If you guys have questions, again, you have my email. I'll send you guys all the different links for the DVD bonus. We're actually doing a free DVD bonus. I think by the end of the month, we have the $7 trials. And how many of you are actually interested in futures trading? Just out of curiosity. We actually have a futures trading mentoring starting up next month as well. So if you've been curious about markets like, just kind of going down the list here, if anybody here is interested in futures, I'm talking about those futures markets, commodity futures, those markets that are related to the Forex, like gold, like crude, trading the dollar index, copper. In fact, I'll show you right now. I call it the Forextra. If you're interested in trading some of these markets that work very much hand in hand with your Forex trading, and even if you don't trade these markets, remember, there's options on these markets. You can trade them alongside a lot of your, the Aussie gold connection, as long as the correlations are valid. Aussie gold, loony crude, the dollar, and darn near every major that you're looking at, the risk environment, the yen and the Nikkei, the yen and the Dow. There are a lot of opportunities to, one, understand more about what's happening in Forex through some of these key futures markets. And I know a lot of you are interested in trading them. There's a lot of different ways to express your ideas through currencies. I don't care if it's currency shares. I don't care if it's individual CME currencies or getting into some of these Forextras. The dollar index is one of my favorite markets to trade alongside any of the majors. The yen, I've played options in the yen. I actually have options that I've been playing in the pound sterling, the BP futures contracts. So I know a lot of Forex traders aren't necessarily interested in trading futures, but even if you don't trade them, physically trade them, there is a lot that you can learn from understanding what's happening in markets like the Dow, in markets like the Nikkei, what's happening to the yen because of them, looking at the dollar and getting a better idea of what's happening at the euro and vice versa. So it's very much an interconnected market, and futures were my first actively traded market. I love the futures markets, and I came to the Forex from the futures markets, and I believe it gave me a tremendous edge. So that's kind of partly what I'll be sharing with you guys. So if you are interested in futures, let me know, and I'll be more than happy to share the information I'm mentoring with you. All right, my friends, that's pretty much it. Okay? I'll send this replay out to you guys. Think about dissecting a pair, understand harmony, the individual currencies, making sure you're not unknowingly hedging yourself. Understand the individual currency stories on both sides of the pair. Don't treat it like a unit. Okay? Directional bias. Are you focusing on pairs that have trends? And when you notice that the trends are literally and figuratively fading away, are you reacting accordingly? One, stopping your trend following approach, and two, going to more of a choppy market approach and slowing down your rate of activity, because within the context of chop, you don't have the organization for longer term follow through. Okay? And then understanding the pip movement range and the point of validity of your trades. Not just I can risk $100, but what does that mean when we talk about the historical hourly and daily volatility of an individual pair, even at a specific time? Okay? So again, if you guys have any particular questions, thanks for the thanks for the heads up with the correction, and just shoot me an email, and I'll see you all in the next presentation, okay? All right, everybody, take care. Thanks for your time, and I'll get this replay out to everybody ASAP. I believe it will be available right here at YouTube pretty much when we end this session. So thanks very much, and hopefully I'll see you in our chat room here really soon.